Good afternoon and welcome to today's webinar, Trading Your First Option Using OptionsPlay. My name is Scott Green, Marketing Director with eOption, and shortly I'll be introducing Tony Zhang from OptionsPlay, and he'll be showing us the OptionsPlay tool on your trading platform. Today we'll be going over basic options strategies, stock trend analysis, option Greeks, common mistakes to avoid, trading examples, and more. For those who are unfamiliar with OptionsPlay, it's a highly integrated tool on your trading platform, on your live trading platform, and it helps you with analysis, strategy, and research for trading options. After I introduce Tony and he shows us the OptionsPlay tool, we'll have time for Q&A at the end. If you have any questions at any point, there is a Q&A box and a chat box that you can submit your questions, and we'll get to as many as we can at the end. Just want to take a moment to share our disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. And we do get questions about the recording of this webinar. After today's webinar is complete, we will track the recording, upload it to our website, and once we have the link ready, we'll share it with all our audience for you to access and watch on demand at any point. You can find OptionsPlay again on your live trading platform. It's not available for paper trading accounts, but is for live paper trading or live accounts. It's on a tab across the top labeled OptionsPlay. That's how you can access it. And if you don't have a live account, you can simply open an account by clicking Open Account button on our website. You can see it there on our homepage, and then click Live Trading. And there you can access the, once you've opened your account, you'll have access to the OptionsPlay tool. eOption is among the leaders with low commission rates set for $3 per stock and options trade and 15 cents per contract. Very popular among high volume traders. And if you have any questions about opening an account, please don't hesitate to contact us at any point. So now I just want to present Tony Zhang, the Chief Strategist at OptionsPlay, based in New York City. Tony has over 12 years in the financial services industry. He oversees the OptionsPlay development team that has led to the creation of some innovative options trading tools and analysis products. OptionsPlay is the flagship product of the company, and it's currently embedded with major sell-side brokerage firms as well as a direct-to-consumer platform. And Tony was heavily involved in the product suite and bringing it to market. And Tony can be heard at many speaking engagements throughout the country. So with that being said, I'll now hand it off to Tony. Tony?
Thank you, Scott, and thank you everyone for joining me this afternoon. Today we're going to be talking about how to trade options. This is a beginner's guide. So before I get started, I just want to talk about the fact that trading options and the process of learning how to trade options is not something that happens overnight. It's something that takes time to learn. So today what we're here to do is really try to break down the starting points for someone who's trying to learn about options trading. And we're going to talk about the basic concepts of two different strategies that you would deploy options with, which is primarily income generation and for speculation. And what we're here to do today is to make this process of learning these strategies as easy as possible for you and show you the different tools that are available to you that are designed to make this process of learning and analyzing and exploring options as intuitive as possible. So OptionsPlay is really designed from the ground up to make options trading easy and accessible, so that regardless of whether you're brand new and starting out with options trading, that you know exactly where to go about to get the right resources to learn about these strategies. And those are some of the things we're going to cover here today. This webinar is recorded. The first half, I'm going to talk about some of these concepts best practices to really show you and break down these strategies. What I'm going to try to do is really equate them to existing strategies that you're already familiar with, because a lot of times people say that options is just completely Greek to me. I don't understand where to even start. So we're trying to make that starting point a little easier for you to compare it with strategies that you understand, and hopefully that gives you an understanding as to why you should consider utilizing options or when you should utilize options. You know, options is just another tool in your toolbox. It's not something that you necessarily will trade every single day or every single time you want to place a trade, but it's important to understand how to utilize options for things like income generation and to speculate with limited risk. So those are the things that we're going to go over here today, and hopefully that illuminates a little bit about what the power of options is. And then more importantly, we want to show you how to actually leverage the benefits of options utilizing the tools that are available to you here. So today what I'll do is I'll go over two basic strategies and the concepts behind them: cover calls and buying calls and puts. One is for income, one is for speculation. We'll break down each one of these strategies to its core so that you understand why you should utilize these strategies. What we'll then talk about is the best practices and starting points with each one of these strategies. Unfortunately, with options, you simply have a lot of options. So this is really where a lot of beginners tend to get a little lost, is to understand where to start. So that's really important to help pinpoint where to start and the tools that are designed to help you do that. Thirdly, I'll talk about understanding the Greeks. This is really where we tend to lose some people, but we're going to try to keep it as high level as possible, or we're going to show you how we actually do the math for you so that you don't have to feel scared because you're not comfortable doing a lot of math. And then lastly, we'll end this with some trading tips just to help you guys avoid the mistakes that people have made in the past, hopefully help you avoid those mistakes when you're starting out. And then lastly, we'll jump over to OptionsPlay to analyze some of these strategies and show you in real life kind of how you can apply some of these things that we're learning to actual stocks that you may have in your account. So that will help hopefully tie all of this together into something that you understand, so that after we finish this webinar, you feel confident enough to log into your trading platform and start utilizing the tools that are available to you to start learning and exploring options. So we're going to start off with two basic strategies that you would utilize options for. The first one is generating income. This is by far the most popular strategy for option traders. About 40% of all trading volume is in the single strategy alone, because it allows you to generate income on the existing stocks in your portfolio. The second strategy we'll explore here is speculation, meaning if you have a bullish or bearish view on a stock, how can you express that view? By buying call and put options, which allow you to express a bullish and bearish view with limited risk. So we'll talk a little bit about the pros and cons of each one and help you compare them so you can understand when to utilize these strategies. So first, we're going to talk about selling a cover call. This is the first basic strategy. When you first apply for an options account, you are first approved for selling cover calls. Simply, it's a simple strategy, and you're essentially selling a call option against the stocks that you already own in your portfolio. And the key here is that you're doing it against stocks that you already own, which means that you're not adding any additional risk to your portfolio. It's something that allows you to generate income on the stocks that you already hold in your portfolio. And the only requirement is that you have at least 100 shares of each individual stock that you sell a cover call on, because each call option represents 100 shares. So you need to have at least 100 shares in your account in order to sell a call option. Now, a lot of people will say, why would I do this, or how does this work? And I think the best way to think about it is think about the stocks that you own in your account. Think about a stock that you own, and maybe you would be willing to sell the stock at a higher price. What would you do if you wanted to sell that stock at a higher price? You would simply enter a limit order, a sell order at a higher price. Then what you do is you wait until the stock rises, and when it hits that price, you're able to sell your stock at that price. So selling a cover call is similar to that, because when you're selling a call option, you're effectively putting in an order to sell your stock at a specific price. The only difference is when you put in a sell order and a limit order, you don't get paid for that. You're just sitting on that order and waiting for the stock to rise and hit that price. When you sell a cover call, you're also placing an order to potentially sell your stock at a higher price sometime in the future. However, you're going to get paid for it, and that's the income that you receive from selling cover calls. So I'm not going to break down, I'm not going to get any further into this. I'm going to talk about speculation, but we're going to come back to cover calls. We're going to have a tangible example for you to drive this point home. But think about from the perspective of the stocks that you own in your account, placing an order to potentially sell your stock at a profit, but getting paid to do so. That's how cover calls work. Second step is, let's say you have a stock in mind, and whether you're bullish or bearish on that stock, you want to be able to play that. You want to be able to take a bet in the markets that a stock will either rise or fall. If you're a stock trader, right now what you would do is you would either buy the stock because you think it's going to go higher, or you can short the stock if you think it's going to go lower. So an alternative to that is buying a call or a put option. A call option is if you have a bullish view on an underlying stock. A put option is if you have a bearish view on an underlying stock. And the benefit here is that because shorting a stock has unlimited risk, shorting a stock requires you to be on margin, requires you to borrow a stock, which will cost money. These are all things that sometimes make it difficult to short a stock. However, with call or put options, you can simply just buy a call option if you're bullish and a put option if you're bearish, and you don't have to worry about borrowing a stock and paying margin interest. You can simply take that view. However, the most important piece is that you have limited risk, because when you buy a call or a put option, whatever you pay for that call option or that option in general, that's the maximum amount of money that you're going to risk. No matter what happens, even if the stock goes to zero or if it goes to infinity, you have limited risk. And that's the key benefit of trading options, is it allows you to take that directional view, but have limited risk in doing so. And that's the asymmetrical risk profile that you're looking for when you're trading options, or that you get from trading options. That's very attractive. So we're going to break down these strategies in the next few slides to show you exactly how these strategies perform based on some real examples. So first, we're going to talk about cover calls. Like I said, it's a fairly simple strategy to understand. It simply takes your existing stock positions, as long as you have at least 100 shares. You can sell a call option against that shares that you own, which is similar to like placing a sell order on that stock. And then that resulting trade is what we call a covered call, and that generates income for your portfolio. So I have an example here. So let's presume that you have 100 shares of Apple. You paid $170 for those shares. What can you do? So let's say you're comfortable with selling this stock at $185 for a $15 profit. You bought the stock at $170. You're okay with selling it at $185 and realizing a $15 profit. So here what I have are two examples of how to go about doing this. One if you just trading the stock, and one if you sold a cover call, and how they would look. So first of all, if you sell a 185 call option, so here what I've done is I'm selling a January 2019 185 call, and what I'm going to do is I'm going to receive $3 income for selling that cover call. So for example, what that means is that, so that's one alternative if you're selling options. The other side is you simply put in a limit order to sell your stock at 185. Both will result in relatively the same thing in terms of if the stock rises, you'll be able to sell your stock at 185 and realize a $15 profit. But the rest of it looks quite different. Number one, when you sell a cover call, because you receive this $3 credit instantly when you sell the call, your risk on the total trade now, instead of being $170 a share if you just own the stock, is now only $167 a share, meaning you've collected $3 for that call premium, which goes to offset the cost of the stock. So now your absolute risk is actually lower. So for example, if Apple doesn't go higher and it just craters and goes all the way to zero, if you had just bought the stock, you're risking $170 per share. Here, you're only risking $167 a share. Not a huge difference, but still you are mitigating risk by selling a cover call. Next, what is your potential reward? So if the stock does rise to 185 and you sell your stock at 185, if you had sold the cover call, you would realize an $18 profit, because the difference between 185 and your net cost basis on the stock is $18 now. So instead of just making $15 on the trade, you're now making $18. So you have less risk and higher reward. If you had just put in an order, you would still only make 15 cents a share because you would only sell it for 185 on a stock that you bought for 170. So as you can see, if you sell a cover call, you have less risk and you have higher reward if the stock does rise. This strategy will be profitable as long as Apple stays above 167 if you had sold the cover call, because you've reduced your cost basis by $3 by selling that cover call. If you simply enter an order to sell your stock at 185, your cost basis remains the same. So as long as the stock stays above 170, this trade will be profitable. And lastly, this will give you exposure only until the expiration date, meaning you're going to collect $3 between now and January 2019. But if the stock doesn't rise to 185 between now and January, you are able to do this again. You're able to sell another cover call, maybe collect another $2 or $3, and further reduce your risk and further increase your reward. And you can do this over and over again until the stock does rise to your limit order or to the price that you're comfortable selling at. And you can do this over and over again. And that's the income stream that you're able to generate by selling cover calls, as opposed to simply selling a limit or putting in a limit order for the stock. So so far as you can see, there's clearly a benefit to selling a cover call than simply putting a limit order. The only caveat or the only downside to this is that perhaps you're not willing to sell your stock at 185. So that's really where it depends on whether or not you want to choose to sell cover calls on a stock that you may potentially lose, because that is the risk that you have when you sell cover calls, is that if the stock rises above 185, you have to sell your stock at 185. Doesn't matter if the stock goes to 200 or 300 or 500, you've sold your stock at 185. That is the downside to selling a cover call, but that's also the same downside you have when you sell or put in a limit order, is that it doesn't matter if the stock runs higher, you will sell your stock at 185. So those are some of the things that to look out for if you're interested in selling cover calls, and helping you compare them to simply just putting a limit order to sell your stock. Next, I want to take a look at, what if we have a bullish outlook on a stock? What can we do? We're looking at buying a call option. So what I want to do is show you the difference between buying a stock and buying a call option, so that you can understand the pros and cons of each one of the strategies. So let's say, again, we're going to use the same example of Apple. It's trading at around 170 right now. Let's say you have a bullish outlook on Apple. What can you do? You can buy the stock. This is the strategy that I think most people are comfortable with or familiar with, buying the stock at $170. Or you can buy a call option. Let's say you buy a January call option, and that call option costs you $8. So both strategies, the outlook is basically when you anticipate gains in the underlying stock or ETF. So if you think the stock's going to go higher, you can buy a stock or you can buy a call option. Both strategies are suitable. Let's take a look at risk. This is really where the difference is extreme, because if you buy Apple stock, your risk is limited to the amount of money that you're paying for that stock. So if you're buying 100 shares of Apple at $170 a share, your risk is limited, but it's limited to $17,000. If the stock goes to zero, you lose $17,000. When you buy a call option, your risk is limited to what you've paid. So your risk here is only $800. So no matter what happens, even if the stock goes to zero, you can only lose no more than $800, because that's what you've paid for that call option. On the upside, on the reward side, you have unlimited upside reward for both strategies. So as long as the stock continues to go higher and higher and higher, you'll participate in those gains, and there's no limit to how much gains you can participate in to the upside. The big difference then comes down to profitability. When do each one of these strategies become profitable? When you buy a stock at 170, as long as the stock moves up even by a penny, this trade will be profitable. You get dollar for dollar exposure. As long as it moves up even by a penny, you will be profitable. That's not the same case for call options. So as you can see, in order for the call option to be profitable, you have to go above the strike price by the amount that you've paid for the option. So if we're buying a 170 call option and we pay $8 for that call option, this strategy is only profitable if the trade goes above 178. So that's the big trade-off that you have between buying a stock and buying a call option. And I'll show you some examples of this to show you exactly if the stock goes up by 10%, How much money do you make for each one of these strategies? If the stock goes down by 10%, how much money do you lose? And that's really how you will be able to make a decision as to which one of these two strategies best suited for you. So as you can see, what you're effectively trading off is limiting your risk severely in exchange for requiring a larger move in the underlying stock before the strategy is profitable. So that's a big difference between buying a stock and buying a call option. And the third difference really comes down to exposure. So when you buy a stock, you will maintain upside exposure in that stock until you sell the shares. So whether you hold on to those shares for a day, a month, a year, however long you hold on to it, that's how long you maintain exposure. On a call option, you only maintain exposure until that expiration date. So you can choose your expiration dates, but you will only maintain exposure up to that date. So those are the big fundamental differences between buying a stock and buying a call option. And buying a put option is very similar. So let's say now instead of you're being bullish on Apple, let's say you're bearish on Apple. So traditionally you'd be able to short a stock. So if you shorted that stock at 170, that's one option that you have. Or you can buy a put option. And I have the same example buying a 170 put option, but now we're only paying $8. But now we're paying $8 for that put option. Both strategies will allow you to basically anticipate declines in the underlying stock or ETF. Just like the call option, one has unlimited risk because if you short a stock and the stock goes up to 300 or 500, there's no limit to the amount of money you can lose when you short a stock. And that's really why I would never advocate anyone to short a stock. If you are bearish on a stock, take a look at some put options. Your risk here is limited to the amount of money you pay for that put. So no matter what happens, the most you can risk here is $800, which obviously looks much better than risking unlimited amounts of money. You maintain the same upside reward. So unlimited upside reward. As long as the stock goes all the way up to zero, you can make dollar for dollar some money on that trade as long as the stock continues to move lower. The difference, again, becomes where do these strategies become profitable? If you shorted the stock, as long as it goes below 170, will be profitable. However, when you buy a put option, the stock needs to move by the premium amount in order for that strategy to be profitable. So if you buy a 170 put and you pay $8 for that put, this stock needs to move all the way down to 162 before the strategy is profitable. So this is really where you start to gain this picture of what you're effectively doing is you're trading off not having as much risk to having to have a larger move in the underlying trade before the strategy is profitable. So that's really the big trade-off that you have when you're trading stock versus options. And lastly, when you short a stock, you maintain exposure until you return the shares. With a put option, you maintain exposure only until the expiration date. So those are the key differences. I really wanted to illustrate these differences to you guys, but I think the best way to learn is actually utilizing the platform and showing it to you. So what I'm going to do is I'm going to jump over to OptionsPlay real quick. I want to show you each one of these two examples here, and I'll move back to this real quick. So this is the OptionsPlay platform. You guys have access to it free of charge with your eOption account. What we have here is the tool, and you can access it by clicking on the OptionsPlay tab. And we created this because when you're looking at an option chain, this is traditionally where you would start if you're looking at options. As you can see, you have different expiration dates, different strike prices. There's a lot of different data that's here, and you can choose from the different expiration dates, different strike prices, and there's a lot of different metrics that are here that help you decide which one's best suited for you. But we have generally found that most people find this page confusing in terms of what all these numbers mean, where to start, and all of that. So that's why we created OptionsPlay. We wanted to make that experience a little easier for you and make it more intuitive. So here for Apple, as you can see, the platform itself is divided into 3 sections. We have trade ideas and watch lists here on the left-hand side. In the middle, we have our security analysis panel. On the right-hand side, we have trading and income. So we're going to explore mostly trading and income here today, but this platform allows you to create different ideas that you have either from pre-built ideas from our trade ideas tab or your own ideas from your watch list. And then you can type in whatever symbol you want to view, and what we'll provide you with is a sense for what the 1 month and 6 month trend is, so you can get a sense for the short and long-term trend. as well as the technical score. This gives you an idea of relative strength, quantified on a score of 1 to 10. 10 are the strongest stocks in the market, 1 are the weakest stocks in the market. So Apple here is 5, it's fairly neutral, which means that it's performing on par with the market, but the trends are quite bearish. So maybe I want to look at some bearish strategies. So as you can see, there's 2 buttons here at the very bottom. One says I'm bullish, and you'll be presented with 3 bullish strategies. These strategies all provide you with not only the strategy itself, but also starting points so that you don't have to worry about what expiration and what strike price do I start with. It provides you with those starting points so you can instantly look at some analytics, or you can select I'm bearish and be presented with 3 bearish strategies. Also same thing, providing you with starting points so that you can jump right into the analytics. So this is really designed to allow you to compare different strategies side by side. And today what we're only going to look at is these 2 strategies on the left. This third strategy on the right is for more advanced users. So if you're new to options play or new to options trading, I think we want to focus our attention at first on the strategy that you're familiar with, which is buying the stock with buying a call option, a simple option strategy so that you can learn more about. So here it's trading at 169.10. Buying 100 shares cost me roughly $17,000. Buying a call option that expires at the end of January only cost me $880. And we have a P&L simulator here at the bottom that allows you to simulate where you think Apple will go and how much profit you would actually expect. So if you think that the stock's going to move back up to 185, 182, you can put those numbers in. And instead of guessing and trying to figure out exactly how much money you'd make, our P&L tool shows you exactly if you had bought the stock, you make a 9% return. If you bought the call option, you make a 98% return. So not only can you see what is your potential reward if you're correct on this trade and Apple does move higher, but actually more importantly, what happens if Apple moves lower? What happens if this continues to slide? What happens if it goes back down to 150 or even further? How much money do you lose? If you had bought the stock, you lose $1,900 if the stock moved down to 150. If you bought the call option, you lose only $880 because that's the amount of money you've paid for that call option. No matter what happens, that's the most amount of money you can lose. So that's really where you can start looking at the potential rewards and the potential risks to help make a decision as to which one's best suited for you. Now, I'm going to come back to this, but I want to show you the income tab real quick. We do the same thing for income. So this is for those of you that are looking to generate income. Maybe you own 100 shares of Apple or any other stock you have in your portfolio, and you want to be able to sell this stock potentially, number one, at a higher price for a profit, but more importantly, also try to generate some income while you do that. So here, this allows you to do the same thing, provide you with starting points, and you can actually customize these starting points based on your personalized preferences. Now, this webinar, I don't have enough time to get into the details of each one of these 2 strategies, but we do have pre-recorded webinars just on cover calls and just on buying calls and puts. So I highly recommend that you view those webinars if you're interested in some of these strategies. So we allow you to customize your own cover call as well as cash secured puts for those of you that are a bit more advanced so that you can type in any stock and instantly be told exactly where you can start. So actually, let's go back to the Apple example real quick because that's the one we've been talking about. Apple's trading just around 170 right now. So this is saying that I can sell a January 4th 180 cover call. So that's like selling my stock at 180. So I'm making about a $10 profit if the stock rises between now and January 4th, which is only 23 days away. But if the stock doesn't rise to 180, I get to keep the $130 of income that I can keep from selling this cover call. So imagine if you can put in a limit order to sell your stock at 180 and get paid $130 to do so. And if it doesn't rise to 180, you can do it all over again and collect another $130. And think about doing that across all the stocks that you have in your portfolio, what type of income stream you can expect. That's what this tool is designed to help you do, because instantly it provides you with the starting point, the analytics to decide, is this enough income, showing you yield numbers and all the information that you need to know as to whether or not this is suitable for you. And most importantly, we explain the strategy to you in plain English. So we want you to understand these strategies before you deploy them, especially if you're brand new. And that's what we built this platform from the ground up, is to help beginners like yourself figure out what is the ideal starting points, give you the analytics so that you can decide whether it's suitable for you. And most importantly, if you're ready to hit that trade button, we will actually pre-fill the ticket for you. So you can hit the preview order button, and the ticket is actually pre-filled for you, so you can send this off for execution. This is all designed to make this process for learning and exploring options as seamless and as intuitive as possible, especially for those of you that are brand new. So let's jump back to the PowerPoint slides. I just want to make sure that we cover a few different concepts that is important if you're going to jump into options trading. First of all, I want to talk about starting points. So even though OptionsPlay provides those starting points for you, I want to make sure you guys understand what those starting points are. When it comes to option strategies, there's really two primary things that you have to select: an expiration date and a strike price. So when it comes to selling covered calls for income, you generally want to sell covered calls that are relatively short term. So anywhere from 3 to 7 weeks out is usually appropriate for this type of strategy. And you always want to start with strike prices that are out of the money. So strike prices that are above the current stock price. Because if the stock's trading at 170, what would you do if you were selling that stock at a profit? You want to sell at a higher price, right? That's why you want to select out of the money calls, calls that are above the current price. So those are starting points that you would typically look for if you're selling a covered call: short-term expirations and strike prices that are above the current price of the stock. If you're buying calls and puts, it's a little different. So covered calls is when you're selling a call option. Buying a call or put is when you're buying an option. So when you're buying an option, you typically want to go a little longer than that. So usually medium term, anywhere from 1 to 3 months out is usually a good starting point if you're trying to buy a call or a put. And when you're buying options, you want to start with at the money calls or puts. So calls or puts that are near the current stock price. There's a variety of reasons as to why this is the case, but I just simply don't have enough time to get into the details of that specifically for this webinar. But like I said, we do have other webinars that do get into some of the specifics to help you understand why these are best practices when it comes to your starting points. But I wanted to make sure everyone understands roughly what are the starting points that you want to look for with both expiration and strike prices. Lastly, what I really want to help drive home the point is understanding the Greeks. These are two things that are very important to understand when you're trading options. You don't have to know how to calculate them. You just have to understand the concept behind them, because the OptionsPlay tool will actually do the calculations for you. So today I'm just going to explain them in more theoretical terms so that you understand what they mean. So when we talk about buying a call option because we think the stock's going to go higher, I think the most reasonable question to ask is, if the stock goes higher, how much money do I make from my option? Or how much money does the call option make me in terms of profits? And that's really what delta tells you, is the change in the price of the option price with respect to the change in the stock price. So if the stock price goes up $1, how much money do I make on my call option? So if you have a call option of this delta of 0.5, that means that the call option will rise by half the amount that the stock price rises by. So if the stock moves up by $1, you'll make 50 cents on the call contract. So fairly simple strategy, a fairly simple concept to understand. It's just telling you how much money you'd make or lose on your option price if the stock goes higher or if it goes lower. The second part that is important to understand, that is a little different than when you're trading stocks, is that the option price will actually change each day with respect to time, because there's a time component built into your option and it does expire. So option contracts will actually lose value as time goes on. So theta tells you exactly how much the contract will lose in value for each day that goes by. So if you have a call contract that has a theta of 0.1, that means this call will lose 10 cents for each day that goes on. So this works either in your favor or against you, depending on whether you're buying that option or selling that option. If you're buying that call option or put option, this is what we call negative theta, because you're actually losing value every single day you hold on to this call option. That's why buying a call or a put option to be bullish or bearish is more of a tactical play. You want to make sure that you're in and out as relatively quickly as possible, because the longer you hold on to it, you're actually going to erode the value of that option. If you're selling option, just the opposite. You have positive theta. That erosion is actually working in your favor. And that's really, again, why selling options is the preferred method of professionals, and it's also the first strategy that you trade by selling cover calls, because you're allowing theta or time decay to work in your favor. So as long as time keeps marching on, you're going to be able to collect some premium by selling options. And that's, again, why this is one of the more popular strategies to trade. So just lastly, to wrap up, some trading tips to help you guys avoid some mistakes that beginners typically make. When you're selling options or selling cover calls, the goal here is to simply hold that cover call until expiration. A lot of times people will ask, if I buy or sell a call option, do I hold it to expiration? Do I exit prior to expiration? When it comes to selling options, the goal is to hold it all the way through expiration. Because if you're able to hold it all the way through expiration, you're likely going to be able to have that contract become worthless. So whatever you collect on the start of that trade, you get to keep all of it at the end of expiration. And the goal with selling options or cover calls or any other option selling strategy is to really try to repeat that cycle consistently. So when I talk about selling a cover call on your Apple stock, and if it doesn't rise to that price, do it again and again and again. And you want to do it across as many stocks as possible to really increase your income stream. So the goal of option selling strategies is to do it consistently over and over again. And lastly, you want to have an exit plan. So I don't have enough time to talk about each one of the exit plans. I highly recommend you to see the cover call webinar. But basically, if the stock shoots up, if the stock moves sideways, or the stock moves lower, you want to have a plan for each one of those. And it's really important to understand how to account for each one of those scenarios before you get into a trade. If you're buying options because you have a bullish or bearish view on an underlying stock, this is really where you don't want to hold the trade until expiration. You want to exit early. Again, that time decay that's working against you is the reason why you don't want to hold on to buying a call or a put all the way to expiration, because it will erode the value of what you've purchased, and you don't want that to erode too much. So you want to be tactical about it. If you buy a 3-month option, you can buy a 3-month option and sell it 2 weeks later. So you're only in that trade for 2 weeks, even though you've purchased a 3-month option. Now, the one big thing that I think is really important to understand if you're buying a call or a put is that you should only do it when you're expecting a large move. If you think a stock's going to move up by 10 cents, 20 cents, 50 cents, don't buy a call option, not the right vehicle. You need to have a large move in the underlying stock in order for it to be worth buying a call or a put. And just like the other trade, make sure you have an exit plan. So if you're bullish on a stock, let's say Apple's at 170 and you're bullish on it, have a target price. Have a price where you'll be able to exit the trade at. The same thing as when you buy a stock. When you buy a stock at 170, you should have a target price, and you should also have a level where you'll be able to cut your losses. Same thing with buying calls or puts. You need to have an exit plan as to when you'll exit that trade because you've hit your target, or when you exit your trade because you've hit a stop loss level where you want to cut your losses. So those are some of the basic tactics for trading these types of strategies. So let's jump back real quick to OptionsPlay. I just want to drive home a few more examples to show you how you can utilize this tool to look for income ideas, to generate income on your portfolio, and as well as look at some bullish and bearish ideas. So I'm going to focus on income first because this is, again, the most popular trading strategy for options traders is to generate income. So pretend that you have a portfolio with a bunch of different stocks that you have. And I have a portfolio here with a bunch of big name stocks, which you may likely own in your portfolio. And what I want to show you is how easy OptionsPlay makes it for you to find a cover call idea on your stock. So let's say you own IBM. Trading at 121 right now. What you can do is you can generate some income on this stock that you own, because if you own IBM, you actually get a really nice hefty 5.2% dividend. This is one of the highest yielding stocks in the S&P 500. So what this tool allows you to do is it first asks you, do you own shares of IBM? You can select yes because you're trying to sell a cover call. You can enter the number of shares that you own. So let's say you own 300 shares of IBM. What it does is it goes through the option chain, it manually searches this whole page, all the expirations and all the strike prices, and it finds the starting point that suits your starting points. And this is driven off of your personalized settings. So please watch the cover call webinar to understand how to create your settings. But what it does is it returns back to you an expiration date and a strike price and spits out all the metrics for that expiration and strike price. So this says that you can sell a January 4th 127 cover call, which means that this stock has about a $6 to move to the upside between now and January 4th, which is only 23 days away. But to place that order to sell your stock at 127 in the next 23 days, you're going to collect $216. That comes out to about 6/10 of the underlying stock, or about an annualized return of about 9.4%. If you own the stock, you're already getting paid a really hefty 5% dividend yield. This is telling you can add an additional 9% on top of that, which brings your total yield to about 14.63%. This is really the attractiveness of cover calls, is because it allows you to potentially sell your stock at a higher price. And if the stock doesn't make that big enough move in the next 23 days, you can collect $215 and do it over again. And you can do this over and over again on all the stocks that you own in your account. And when you're ready to hit trade, you just hit the trade button, preview order, and it enters the order for you so that you can quickly do this on all the stocks that you own in your account. And this tool is designed to allow you to click on any symbol and within a few seconds know exactly which expiration and strike price suits you for this particular stock, so that you never have to pull up an option chain and manually go through pages and pages of this to calculate any of this stuff manually on your own. It does all of that work for you. All you have to do is simply click on a stock, and it presents to you the cover call expiration and strike price. Now, I only have a couple of more minutes, so what I want to do is I want to make sure that I also cover, if you have a bullish or bearish view, how you can utilize this platform very easily. But as you can see, this really allows you to set up a watch list within a few seconds, know exactly which cover calls to sell. So if you're interested in that, I highly recommend you take a look at the cover call webinar that we've done. Utilize this tool to help make your life a little easier when it comes to searching for that expiration and strike price starting point. So let me just jump back to the trading tab. Let's say you have a bullish or bearish view on a stock. How can you quickly leverage that? I was looking at Tesla earlier because this is certainly one of the stocks that has really done well, even though earlier in the year this was one of the underperforming stocks. You know, Elon Musk got into quite a bit of trouble, but that stock has really come back to life as we've gone through this major sell-off in October. The stock has rallied from 260 to 360 over the couple of months while the markets have been doing nothing but moving lower. So this is one of the stocks that maybe if, let's say, you're bullish on the stock, you might want to consider taking a look at a way to explore this. And the reason that I want to use options is because this is trading at near all-time highs. I'm never comfortable quite buying the stock at all-time highs because I'm always concerned, what if the stock plummets back down to 260? I'm going to be risking a lot of money to do that. So another way I can anticipate this upside or take advantage of an upside is to buy a call option. So buying 100 shares of stock cost me 36 grand. That's a lot of money. Some of you may not even have that kind of money sitting around. So buying a call option is only going to cost you $2,800. So that's still quite a bit of money, but it's obviously substantially less. And this stock's trading at 360 right now. Maybe I think the stock can go to 390 or maybe 400. So this allows me to type in my outlook as to where I think the stock will go. So if I bought the stock, I make an 8% return. If I bought the call option, a 24% return. In my opinion, this is actually not very good if the stock rallies all the way to 400. As you can see, the stock really needs to move a little higher to 425 before these returns look very attractive. And that's part of why this has a lower options play score, because the risk reward of this call option is actually not very attractive. So maybe that's not a trade that I want to make, but this really allows you to explore the difference between buying a stock and buying a call option and seeing whether the strategy is suitable for you. And more importantly, what happens if I bought this stock and the stock goes back down to 260? If you had bought the stock, you lose $10,000. If you had bought the call option, you only lose $2,800. And that's the benefit of options. It allows you to take a directional view with limited risk. And you can do this for any type of strategy. So for example, here, if we were instead bearish on Apple, so if I click on I'm bearish, I can short the stock, which will cost me some amount of margin, or I can buy a put option for $760. So if the stock does drop to, let's say, $150, I can easily model what these look like. If I shorted the stock, a nice 11% return. But if I bought a put option, 163% return. So substantially higher return by buying that put option. The stock does need to move quite a bit in order for me to make that return, about a $20 move to the downside. But we've seen about a $20 move on the stock in just a couple of weeks. And this I have until the end of January to do for that same $20 move. But conversely, I think there's always the risk that maybe tech rips back higher, even though Apple has not really participated in any of these rallies that we've seen. But I always think that that's a risk on a big name stock. If the stock goes all the way to 190, which is where it was just in mid-November, if I shorted the stock, I lose $2,100. That's a lot of money to be risking just in case that the stock rallies. This is still a relatively strong, fundamentally sound stock. But if I bought that put option, I'm only risking $760. So that's really how you can utilize this tool to quickly compare buying a stock to buying a call or shorting a stock to buying a put, so that you can quickly decide, is this a strategy that I want to do? If you do, you hit the trade button. And again, you can hit preview order and it pre-fills the ticket for you. So this allows you to quickly utilize this tool and immediately analyze the trade and send this off for execution. So with that, I just want to thank everyone for taking the time out this afternoon. I really hope that you guys have found this webinar useful in helping you guys better understand these basic option concepts, but more importantly, showing you guys that you guys have the tools at your disposal to make some of these investment decisions, even if you're brand new to the strategy, because OptionsPlay makes finding your starting points as easy as possible, breaks it down to you in plain English, and gives you all the analytics you need to make a decision very, very quickly. So with that, I'll open this up for Q&A. If you want to type your questions either into the chat window or the Q&A window, I will answer as many questions as I have time for. It looks like there's already a few questions, so please type them into the chat window, or if you have, or type them into the Q&A window. So I have one question here. So if we buy a put and let it go until expiration, are we buying the stock? What do we do in order to get out of the expiration? So you simply just, a great question, David. So the question was basically, if you own a call or a put, how do you exit the trade? So you actually go to your positions and you'll be able to close out your positions straight from here. Let me see if I can, I only have orders, I don't have any positions. So next time I'll load up some positions to show you, but the best thing to do is call your broker. They'll be able to show you how to close an order. It's basically the same thing as selling the stock that you own. So if you own 100 shares of the stock, what would you do to get out of it? You'd sell that stock. You do the same thing for the put option. When would you ever say no to the answer of owning stocks? Sounds like one would always say yes to in this OptionsPlay tool. So I think the Tesla example is one where I probably would not have bought that call option, right? So here, looking at Tesla, and I think this is really what I was trying to illustrate. You need a big move in the underlying stock in order for this to be profitable. So as you can see, even if the stock goes to 400, which is still a $35 move on the stock, this strategy only returns me a 24% return. In my opinion, not a good enough return to be worth buying that call option. As you can see, we have an OptionsPlay score of 73, and that's red. That's basically telling you the risk reward of this call option is not very good. So here's a prime example, I think, where I don't think that I would necessarily buy this call option because the returns just aren't big enough. The stock has to move all the way up to 425 by the end of January, which I think is a big ask for a stock that's already moved 100 points over the last couple of weeks. So the stock has to move to 125 before these types of returns look interesting to me. So I think that's an example of that. I hope that illustrates when potentially I would rather buy the stock than buy a call. So we buy a close. You sell to close, David. To close, any closing position is always to close. It's just a matter of whether you buy to close or sell to close, depending on what your initial order was. Greg is asking, does OptionsPlay trade recommendations reflect all possible strike expiration dates possible? So let me just be very clear that we are not recommending any trades. We are simply providing starting points based on what we laid out here. So we talk about selling cover calls is best to start off with short terms out of the money calls. This is exactly how we select the starting points for you. When you're buying calls, we always select medium term at the money calls for you. We're not by any means recommending this trade or telling you that that's the best trade to make. We're simply providing starting points that follow best practices when you're trading options, whether you're selling or buying options. We're adjusting for that automatically for you. Does OptionsPlay have a P&L tracker? So you can, so currently we don't. However, if you have a paper trading account at eOption, you can paper trade these trades in order to have access to tracking these trades P&L. So that's where we refer to the brokerage firm to help us do that. Scott, I think I answered your question, Scott, with respect to owning the shares. And keep in mind that, you know, there's no substitute for a long-term fundamental play, meaning if you, for example, fundamentally believe that Tesla is a great company and you think that it's something that you want to hold on to for the next 5 years or 10 years, there's no substitute for owning those shares. So buying a call or a put is only a short-term speculative strategy. So buying a call or a put is really only useful when you're expecting a short, quick move and you want to play that with limited risk. If you simply want a long-term investment in something, buying the shares is by far the better strategy to do there. Would you explain the color in the circle around each circle? So that's what I was referring to here is the OptionsPlay score, which is the risk to reward of each strategy, is reflected in the circle, in the score. And the higher the score, the better, and it's color coded for you. So when it's red, that's telling you the risk to reward of this call option is not very good. It's actually quite poor. The risk to reward of these two strategies are a little better because it's red. And as you can see, the risk reward of these strategies are much better. So this is really designed to give you a sense for risk to reward and then allowing you to compare it side by side. So if you want to get out, I think I've already answered that question. Can you analyze QQQ? So I don't have much time, but I'll try my best. So the Qs, in my opinion, have certainly had an interesting time. In my eye, this does look like a bit of like an inverted head and shoulders. Maybe that's wishful thinking that I think that tech will recover a little bit, maybe back up to 172, 175. So let's take a look at bullish. Again, this is by no means a recommendation to trade the Q. This is simply just my personal opinion on the Qs. So let's say I'm bullish on the Qs. I think this could go back up to maybe 175 over the next few weeks. So I can click on I'm bullish. So if I bought 100 shares in the stock, it will cost me 17 grand. Buying a call option will cost me 576. So let's say the stock goes up to 175 by the end of January. Here, if I bought the stock, a 6% return. If I bought the call option, a 73% return. And I can even assume that what happens if this makes that move by the end of January. So let's say by the end of January, the stock goes up to 175. I'm going to make a 78% return buying that call option. And just in case tech sells off, which I think is highly possible these days, let's say this thing cracks back down to, let's say, 157 or even 150. I think this is really the true risk here, which is why I'm uncomfortable just buying outright the Qs right now, which is why I would certainly prefer to trade the call option, because if the stock does plummet, here I'm losing $1,500, here I'm losing $574. So substantially less risk for the same upside. I hope that answers your question on analyzing the Qs. Can you briefly explain how to purchase stock via a put option? Do you recommend this strategy? So that is a slightly more advanced strategy, but that's under the income tab. So when you don't own shares of the Qs and you want to own shares of the Qs, what you can do is you can sell a put. That's a completely different strategy. We didn't cover it, but imagine putting a limit order to buy the stock at 165. I'm sorry, it's trading at 165 right now. Imagine putting in a limit order to buy the stock at 160, which is what you're doing when you sell a put, and you're going to get paid $223 to place that order. This is actually a really powerful strategy to accumulate stock. It's one of the strategies I certainly use in my portfolios, and I highly recommend if you have a bit more experience trading options as a strategy to explore, because it's the same thing as putting a limit order to buy the stock, but you're going to be able to get paid some income to do so. So shorting a stock is one strategy to do so, but it is a bit more advanced strategy. It does require you to have substantially more cash to do so, because if the stock goes below 160, you now own 100 shares at $160. So you need 16 grand in your account in order to do this, unless you're in a margin account. But still, you need a substantial amount of margin to sell a short put. But if you want to own the stock anyway, it's a really good strategy to, as an alternative to outright just buying the stock as it is, because you don't get paid to put an order to buy the stock. You do get paid to put an order to sell a put. Mike, on the real-time options play, can you show where the trade tab is located on the platform? It's right. I'm not sure what you're referring to. It doesn't matter whether you're on real-time or delayed. It's the same. The trade tab is right here. If you're seeing something like this, you can click on the show trade panel here on the upper right-hand corner of your chart to see the trading and income tab. Exit strategies are covered in the cover call webinar. Yes, so at the end of the cover call webinar, we cover the 3 different scenarios. The stock goes higher, if it goes sideways, and if it goes lower, and how to handle each one of those. Any other questions? If I have a put and the stock is going up, how can I change to a call option? I'm not sure what you mean by change to a call option. You can't just change it. That's like saying, how do I change a long position to a short position? You can't. You'd have to sell the position and buy a new one. So you can't just change a call or a put. You must sell the put and then buy a call option if you want to flip it. Does the cover call concept also apply to trading futures? No, because you do need an underlying stock. I mean, I guess in theory, if you own the future, can you sell a cover call on that future? Yes. But that's a whole different asset class. I'm unfortunately not here as an expert on trading futures or options on futures, so I don't want to speak out of turn. In theory, it should be the same, but I don't know if you can cross margin between the future contract and the option. So I'm going to unfortunately decline to answer that question simply because I don't know the answer. Can you paper trade on OptionsPlay? You can't paper trade on OptionsPlay. You can paper trade at eOption. It does require you to have a live account first, though. Green check next to the green circle. That just simply means that this is the strategy with the highest OptionsPlay score out of the 3. So there's another example where, you know, buying the stock will give you better risk reward than buying that call option. Because what this is saying is paying $576 for a call option is kind of expensive. Your risk reward, the stock really does need to make a fairly significant move in order for the strategy to be profitable. When I select the trade tab on the live trading platform, nothing happens. I'm not sure what you mean by nothing. When you say the trade tab, what's the trade tab? If we open an account with eOption, we get OptionsPlay. That is correct. What about us that paid for a full year? So David, if you have a question about a subscription directly to OptionsPlay, shoot me an email at info@optionsplay.com. I'm happy to answer that. But right now, I'm here to talk about what you get here at eOption. Is there a way to buy, sell both sides of a vertical trade on this platform? Can you demonstrate that? I'm not sure what you mean by both sides of a vertical trade, but if you're referring to placing a vertical trade, yeah, absolutely. You can trade this as a single strategy. You just hit the preview order button. I'm not sure why this is saying there's no January 25th. That seems like an issue on the eOption platform. But let's say I'm looking at the January 18th option. You just hit the trade button, and when you hit preview order, it will pre-fill both legs. If that's what you're referring to, when you say both sides of a vertical trade, if you're referring to both legs, then yeah, you can do this in both your option chain. You can do it in the order entry screen. You can select multiple legs. So if you want to buy that and sell that, you just hit the trade button and it allows you to enter a trade. And I would recommend that when you're trading spreads to always enter the order as a single order, never as a separate order. This software is not eOption. This is your eOption platform, which includes OptionsPlay free of charge as part of that when you have a live account.
That's about all the time we have here, Tony. Was there any last questions you wanted to get to?
Nope. I just want to thank everyone for taking the time out this afternoon. I hope you guys found this useful, and I highly recommend you guys to take a look at the other webinar recordings for some of the more in-depth stuff on these specific strategies. So thank you, everyone, and I hope you guys have a great afternoon.
And thank you, Tony. Great job as always, and thank you to everyone who logged in and listened to today's presentation, and thank you for your questions. More questions, the better. If you have any more, please reach out to us. Here's our phone number and our email address, how you can reach out to us at eOption. We'll be happy to address any questions that you have. Once again, if you don't have a live account, we encourage you to sign up today, and you can access OptionsPlay and get low trade commissions at $3 per stock options trade at plus 15 cents per contract. Thanks again, everyone. Have a wonderful rest of the day, and feel free to reach out anytime you have any questions. Thank you. Bye-bye.